Hello and welcome to the Oracle's Classroom. In this video, we're going to be taking a look at the statement of cash flows in our beginner series of how to look at financial statements. And in the balance sheet segment, I provided an overview of where to find the financial statements, and I will link that in this video. So let's jump into the cash flow statement. And just like the balance sheet and the income statement, we have the company's name up top and we have the name of the statement. Now, like the balance sheet was a point in time, the income statement was a period of time, and the cash flow statement is also a period of time. And the best way to think about the cash flow statement is really tying the balance sheet and the income statement together. So a lot of people put, I think, too much emphasis on, I hesitate to say too much emphasis because they're so important, but I guess forgetting the cash flow statement, in my view, is a mistake because they really tie them together and they give you additional information that you really can't gain easily from, just looking at, say, the balance sheet. But just from a very high level here, so the statement is just what it says. It's how cash has flowed into and out of the business or through the business over the period of time. Now, the cash flow statement. So just a quick note, there's two main types of cash flow statement. There's the direct method and the indirect method. And we're going to focus on the indirect method because it's the most common. It's what most companies present. Although I had a career in banking, and we did use the direct method. Our computer program, our spreading system, did give us the direct method, and there are advantages to using it, and you can see some interesting things. But we're going to focus on the indirect method, which I think, I could be wrong in this, but I think it's the SFAS 95. I think this was first institutionalized in 95. But anyways, the indirect cash flow statement is broken into three main segments, and we see that here: operating activities, investing activities, and financing activities. So we'll just start at the top. And so the indirect method starts with net income. And so, this figure here is including the non-controlling interests. So it's the whole company, regardless of whether there are minority or non-controlling interests in here, because we're really talking about the whole company, the operations of the business. So it starts with net income, which can be positive or negative. And then you add back, they're adding back depreciation and amortization. Because those are non-cash. And remember, we're just focusing on items that impact cash. And so, when we think about depreciation and amortization, we won't get into the economic impact of the validity of whether they're real or true non-cash expenses. But from an income statement perspective, no cash has left the business. So it's included in this net income figure. So it's already been deducted from operations to get to net income. So we have to add it back, and that's what this does here. There are also some other items that get added back, such as stock-based expense, some deferred income taxes, the impairment charges that we saw on the income statement, write-downs would get included here because, again, they're non-cash in nature. So if it's an expense, and this is where it gets a little bit tricky, but if you just remember cash in, cash out. So positive numbers are cash in to the business, and negative items here are cash out. So what this means, we'll just use stock-based compensation and deferred income taxes for a minute here. The income statement included an expense of $51,899,000, but it also included a positive adjustment for deferred income taxes. So what that means is the 51 was, we have to add that back, and the deferred, because it was not an actual positive, gets deducted. So that's that's sort of those first couple of here, and then you get into the changes in the assets and liabilities, in this case net of acquisitions and divestitures. So again, so using accounts receivable, these are the major balance sheet items. So really what we're saying here is, and you can calculate this directly from the balance sheet, and it's worth doing just to see, one, where it comes from, but two, in the rare instance that the company's off, but you can generally trust these numbers. So accounts receivable, so that was cash. It's a positive number. So that means accounts receivable actually went down. So that means the company was collecting its receivables faster than its sales. And we can tell by this statement below here that inventories grew. And we knew that because it's a negative number. So those are quick. The cash flow statement provides a quick and easy way without calculating those changes yourself directly from the balance sheet. And we can see that here with the prepaids, the accounts payable, accrued taxes, and these other items here. They come directly from the balance sheet. And, from any given year, you look at this, it really, it illustrates that business is lumpy. You don't want to see inventories growing as a percentage, too quickly. If a company continually is building inventory, that might mean something bad. Same with accounts receivable. You can tell quickly that a business is reporting sales and it's reporting profits, but it's actually not collecting the cash. So as revenues grow, you might expect the investment in receivables to grow as well. You just want to make sure that it's not outsized in relation to revenues. So let me get to this net cash provided by operating activities. Now, usually, generally speaking, you want to see this always positive, because that means there's cash coming in from operations, and that's a good thing. Now, it's sort of you have to be careful, because it's almost like an EBITDA, or earnings before interest, taxes, depreciation, and amortization number, because what you don't have, so we're adding back depreciation, but we don't know how much additional capital was put back into the business. And that's the investing activities section. So generally, there's the main one you're going to see is additions to property, plant, and equipment. But in this case, they call it capital additions, which includes software. So if you were looking at the free cash flow of the business, you would take this operating activities number and deduct this outflow for capital additions. So the second line is actually sales of plant and equipment. If something wore out, or they took a plant offline and they sold it, that's down here. We also see proceeds from sales of businesses. You'd see business acquisitions, which are listed on a separate line item. Again, negative numbers being cash out, positive numbers being cash in, which makes sense. So again, investing activities, it just separates out the capital allocation decisions that the company is making to the business. And so you should be able to see, without getting into too much detail here, if you're seeing a business that is continually adding to its property account, continually acquiring businesses, you're going to see depreciation grow and amortization grow. But you should also see net income grow, right? So you want to, it's a key insight into how much capital and where the capital is being spent, what management is doing with that cash. And then finally, the financing activities here. So that's really, you can almost consider these top two as if, the business was 100% equity financed. Where is the capital going into and out of this business? And then the financing activities, it tells you, okay, who's putting up that money? Is it debt? Is it equity holders? And so we can see from the financing activities section here that Hershey had a net decrease in short-term debt. They borrowed an additional amount of money here, and leases are also included here as well. Usually they're much smaller than the other items. So the top couple here relate to debt, and then as you get down to the bottom, just like the balance sheet, equity is listed at the bottom. Cash dividends paid. We can see how much the dividends paid over time here, as well as repurchases of shares. Sometimes this is net repurchases of stock or net changes in common stock. If it's a positive number, that means that the business sold shares. And in Hershey's case, we can see that the exercise of stock options actually brought in this case, 241 million this year. So it gives you an insight into some of the changes, again, the capital allocation decisions, but the changes that are happening on the other statements. So you take those three numbers, the main numbers here: operating activities, investing activities, and financing activities, and those add up to the change in cash. And so you can see the change, in this case, a net decrease in cash, what it was at the beginning, and what it is at the end of the period. Another key piece of information here on the cash flow statement, sometimes they're in different forms or they have different items, but usually you will see an interest paid and income taxes paid, because there are slight differences between the accounting when an expense gets matched to the period in which it was incurred and when it was actually paid. So in this case, we can see the actual interest that Hershey paid and the actual income taxes paid here. And again, just like the other statements, there's a note to see the notes to the financial statements, which are integral to this. So again, not to be read in isolation, but you can gain quite a bit of insight into the business by just taking your time, just going through these, and just kind of keeping in your mind the numbers that you saw elsewhere, and trying to put them into what they actually mean, what you're seeing, what the management team is saying about what they're doing and what they're thinking about doing, and really just getting a sense for how the business is evolving over time, because it really is a motion picture versus a snapshot in time. So thank you so much for watching. I hope you enjoyed this. Please, again, if you have any comments, questions, general or specific, beginner, even if it's a quote unquote silly question, you can always email me at theoraclesclassroom@gmail.com. And love to hear from you, your comments. Please like, subscribe. Really trying to build a base of a community here, and hopefully we can learn together. So thanks again for watching, and we'll see you next time with the statement of changes in shareholders' equity. Have a great day.